On June 21, 2005, the world watched as the once mighty telecom giant WorldCom vanished overnight, its stock price plummeting by $20 billion in a single day, shattering investors' confidence and rewriting the textbook on corporate fraud. Founded in 1983 as long-distance discount services, the company rebranded as WorldCom in 1995 and, under the charismatic leadership of CEO Bernie Ebbers, surged to become the second-largest long-distance carrier in the United States. The 1990 saw an industry frenzy of mergers, acquisitions, and the promise of a new digital era. WorldCom's aggressive expansion, financed by debt and bolstered by a relentless appetite for growth, painted a picture of unstoppable success that dazzled analysts and fed an ever-rising stock price. Behind the glossy press releases, however, a culture of secrecy and pressure began to take root. Ebbers, a charismatic Texas oilman turned telecom titan, demanded ever higher earnings to justify his empire-building strategy. When the dot-com bubble burst in 2000, the company's revenue slowed, and the pressure to meet Wall Street's expectations grew unbearable. In the boardroom, the mantra became simple: if we can't grow the business, we must grow the numbers. The fraud itself hinged on a deceptively simple accounting trick. WorldCom's finance chief, Scott S. Seymour, and a small inner circle began to capitalize ordinary operating expenses, particularly line costs associated with leasing network equipment, by recording them as long-term assets on the balance sheet. This practice inflated earnings by roughly $3.8 billion in 2002 alone. At the same time, the company created false intercompany accounting entries, known as corporate unbundling, that shifted billions of dollars from expense to revenue, masking the true financial health of the firm. The scheme went undetected for years because the company's internal controls were weak, and the auditors, Arthur Andersen's successor KPMG, failed to probe deeply enough into the irregularities. It wasn't until internal whistleblower Cynthia Cooper, a senior accountant in the finance department, discovered the irregular journal entries and reported them to the board that the house of cards began to wobble. In June 2002, WorldCom's internal audit team uncovered $3.8 billion in questionable entries, prompting an immediate restatement of earnings. The company's stock nosedived, and the Securities and Exchange Commission launched a criminal investigation. The legal battle that followed was as monumental as the fraud itself. In 2003, a grand jury indicted Bernie Ebbers, Scott Seymour, and several other executives on charges of securities fraud, conspiracy, and filing false statements with the SEC. The prosecution painted a picture of a conspiratorial cabal that deliberately manipulated financial statements to hide mounting losses, while the defense argued that the misstatements were the result of reckless accounting rather than intentional deception. The trial, which began in April 2004, was a media circus. Prosecutors presented a mountain of evidence, internal emails urging the recapitalization of costs, forged documents, and testimony from former employees who described a culture of intimidation and blind obedience to Ebbers' demands. The jury heard how Ebbers, who had pledged his personal fortune as collateral for the company's debt, pressured the finance team to make the numbers work, or risk the collapse of the entire conglomerate. In July 2005, after weeks of deliberation, the jury returned a guilty verdict on all counts against Ebbers and Seymour. Ebbers was sentenced to 25 years in federal prison, a record length for white-collar crime at the time, while Seymour received an 8-year term. The court also ordered the company to pay $2.6 billion in restitution to investors, though the actual recovery would be far less due to the massive losses incurred. The aftermath of WorldCom's collapse rippled through the entire corporate landscape. The fraud, then the largest in U.S. history, shocked regulators into action, accelerating the passage of the Sarbanes-Oxley Act of 2002, which tightened financial reporting standards and imposed stricter penalties for corporate misconduct. Auditing firms overhauled their internal controls, and boards across the nation instituted more rigorous oversight committees. Investors grew skeptical, demanding greater transparency and accountability from CEOs whose promises once seemed infallible. For the employees of WorldCom, the fallout was personal and devastating. At the height of its expansion, the company employed over 60,000 people worldwide. The bankruptcy left tens of thousands jobless and erased retirement savings for many who had invested in the firm's stock through their 401(k) plans. Communities that had relied on WorldCom's tax contributions faced budget shortfalls, and the telecom industry itself entered a period of consolidation as competitors absorbed the shattered assets. In the years since, the WorldCom saga has become a cautionary tale taught in business schools and featured in documentaries, reminding future leaders that unchecked ambition, when coupled with weak governance, can erode the very foundations of an enterprise. The story also underscores the power of whistleblowers, whose courage to speak truth to power can ignite the chain of events that ultimately expose the darkest corners of corporate America. Today, the name WorldCom lives on only in legal textbooks and in the memory of a market that learned at great cost that the line between bold vision and reckless deception can be razor thin. Subscribe to The Verdict for more stories like this.